So, are we heading towards another recession? It's in everybody's mouth right now. Recession here, recession there, recession everywhere. But what is a recession? A recession is a period of economic decline signaled by an increase in unemployment, a drop in the stock market, and a dip in the housing market. An official recession is not declared until the total value of goods and services in the US, also called gross domestic product or GDP, has been in decline for 2 or more quarters. Or simply put, a recession is when the economy stops growing and starts shrinking. You might ask, what causes recessions? A recession can get started with sudden economic shock, when a surprise problem creates serious financial damage, like the COVID outbreak, which shut down economies around the world. Excessive debt, when individuals or businesses take on too much debt. The cost of servicing the debt can grow to the point where they can't pay their bills. Asset bubbles, when investing decisions are driven by emotions, bad economic outcomes aren't far behind. Investors can become too optimistic during a strong economy. Former Fed Chair Alan Greenspan famously referred to this tendency as irrational exuberance in describing the outsized gains in the stock market in the late 1990s. Irrational exuberance inflates stock market or real estate bubbles, and when the bubble pops, panic selling can crash the market, causing a recession. Too much inflation. Inflation is the steady upward trend in prices over time. Inflation isn't a bad thing per se, but excessive inflation is a dangerous phenomenon. Central banks control inflation by raising interest rates, and higher interest rates depress economic activity. Too much deflation. While runaway inflation can create a recession, deflation can be even worse. Deflation is when prices decline over time, which causes wages to contract, which further depresses prices. When a deflationary loop gets out of hand, people and businesses stop spending, which undermines the economy. Central banks and economists have few tools to fix the underlying problems that causes deflation. Technological change. New inventions increase productivity and help the economy over the long run, but there can be short-term periods of adjustment to technological breakthroughs. In the 19th century, there were waves of labor-saving technological improvements. The Industrial Revolution made entire professions obsolete, sparking recessions and hard times. Today, some economists worry that AI and robots could cause recessions by eliminating whole categories of jobs. So then, what happens during a recession? Well, GDP falls. Economic activity becomes shaky and companies cut back in an attempt to survive. These corporate cutbacks lead to layoffs and unemployment. Watching other people get laid off causes those who are still employed to worry that they are going to lose their job, which leads to less consumer spending. Government debt rises as it attempts to stabilize the economy. The Fed cuts interest rates in an attempt to stimulate growth. Stocks and other assets like homes lose value, and a full-fledged financial crisis is underway. Okay, but how long does a recession last? The Great Recession lasted for 18 months but was unusual. If you take it out of the equation, the other 10 recessions since the World War II have lasted between 6 to 16 months, or an average of 10.4 months. It's important to note that the US economy falls apart and rebuilds itself quite regularly. What set the Great Recession apart from other recessions was how long it took to rebuild. Okay, now the most important question: how to invest during a recession? There are multiple ways to manage your finances to prepare for a recession. Start by building your emergency savings. As you work on recession-proofing your finances, it's very important to have emergency savings in place. In a recession, having an emergency fund can save you a lot of stress. It can also help you avoid becoming financially overextended or having to leverage debt just to get by. I always keep aside about 6 months of my basic living expenses in an emergency account in case I get laid off of my job, for example. Diversifying your investments. We all heard the saying, don't put all your eggs in one basket. Well, the same thing applies to your investments. It's important to have a well-diversified investment portfolio. That means your investments should not all be tied up in one stock or one real estate property or one crypto. You want to make sure that your investments are spread across multiple industries and areas, so if one industry or area experiences a decline, it doesn't sink your entire portfolio. I try to be diversified in the stock market, where I own multiple stocks in Canada and the US across multiple sectors, in the crypto, where I own mostly Bitcoin and Ethereum, and real estate. Mutual funds and index funds are also great ways to diversify. Whatever you invest in, be sure to do your research, be clear on your investment objectives, and understand your risk tolerance. This will create less panic for you if a recession comes along. A big mistake people make is that they start selling every investment they own when the economy dips. This is a really bad idea. If you have a clear plan for your investments, and if you're in it for the long run, you are in a good place. Your investment is likely to weather a bad economy and comes out on top. Paying off debt. The last thing you want to do is worry about having to pay off debt in a bad economy, especially if there is an increased rate of unemployment. Paying off debt will save you a ton of money in interest payments. It's usually a good idea to focus on paying off your high interest debt before you consider investing. If you have a high interest debt, the cost of your interest payments may far exceed the return on your investment. For instance, if you have a credit card that has a 19% interest rate, then it makes more sense to pay off that debt as soon as you can, given that the average long-term rate of return on the stock market is about 10%. Of course, your rate of return could be much higher, but you want to avoid speculating or trying to time the market when you have a high interest debt to pay off. Once your high interest debt is settled, you can focus on investing. Learning how to budget and living within your means. Living within your means is the key to building wealth. It also means you eliminate having to leverage debt to live your life. No more using credit cards to pay your bills. Your budget will help you track your expenses compared to what you earn and highlight areas you can cut back on. Personally, I use Mint to track and budget my expenses. Your ultimate goal should be to widen the gap between your income and expenses as much as you can. You do this by increasing your income and reducing your expenses. The money you have left over is money you can use toward the things that really matter to you, like your savings and investment goals. Creating multiple streams of income. Did you know that the average millionaire has 7 sources of income? Creating multiple streams of income ensures that you increase how much you have coming in. It also acts as a buffer in case you lose a source of income. If there is something you are passionate about doing or something you get complimented about all the time, well, try turning it into a side hustle to generate some additional income. There are also a variety of recession-proof businesses you can consider. Living on one income and saving the other. One of the savviest financial moves you can make to prepare for a recession is shifting to live on one income and save the other. Getting frugal with your budget and reducing expenses can free up a lot of money to save for a rainy day. The goal is to reduce your cost of living enough to free up the secondary salary altogether. This way, you will be able to increase your emergency fund and cash position to take advantage of opportunities in the market, but also not having to rely on a second income in the event of a job loss. Living below your means is the best way to prepare for the unexpected. Considering a recession-proof job. Another way to prepare for a recession is to consider a recession-proof job. Healthcare workers, teachers, pharmacists are types of jobs in demand even during a recession. Expanding your skills is excellent for job security, especially when it comes to working remotely. Companies are shifting toward remote positions now more than ever. Since work from home jobs are on the rise, why not consider starting your own home-based business? You can make a great living doing a variety of different jobs at home. There you have it, guys. If you found some value, please consider liking the video and subscribing to the channel. Thanks for watching and see you on the next one.